Welcome to the weekly update, where I'll go over the action in the market for the week of August 12th through the 16th, and then we'll see how things look for the week of August 19th through the 23rd. We had a really solid up week. Ever since we saw that big decline back on August 5th, the market has been rebounding. We were negative a week ago with looking at all the daily charts. Well, we've switched back over to positive, both in the short, intermediate, and long term on the daily side. And we're showing some improvement here on the weekly side. But there are some things we just want to be aware of as we're going through the charts. Before I get started, there is a daily video that I do that if you're a member of the program that I have, you have early access to that. The daily videos are then made public right when the market closes for that particular day. But the videos are also designed to apply to the day that just finished. So if you want to have early access to that, I'll be talking about the program and links where you can get to that. But the daily videos are the real focus of what I look at. There's a PDF available in the description below this video. There are pivot points that I update every day on the YouTube community tab, both that apply for the whole month and those that are unique just to that particular day. I do have a private Facebook group. If you don't really have an interest in joining the program that I have, but you still want to have some back and forth, this is not a public group on Facebook. All you have to do, if you're already on Facebook, just send me a request and we can have some back and forth. There's not an awful lot of action in that group, but if you want to change that, you're more than welcome to give it a try. I really go through and watch YouTube and Rumble comments. The garbage comments get deleted, specifically these folks that are social media experts. I didn't know the world was so full of all of these experts on this stuff, but pretty much every day I have to go through, especially on Rumble, and delete 2 or 3 comments on every video. And I also post on Rumble, as I mentioned here, and sometimes if I'm having problems on one platform, go over and look for me on the other platform. So here's the program that I have. It's called the SPX Investing Program. It's still free, and I'm actually extending that a little bit. So if you want to come in now, there's no cost. You just have to sign up with an email address. There's a link below this video that will take you to the website. Also a link that will take you to some more videos. Here's an email address if you have any questions or any kind of feedback that you may want to send to me directly. And the daily video is the real foundation of the analysis that I do. Here's the weekly video. It really is meant to tie into the daily video, but I do a number of weekly videos. All of them point to the daily video. Another YouTube channel that you may find helpful if you're a longer-term investor, even if you're shorter term, you still may find this helpful. It's Schiff Capital, and he puts out a weekly video. He's a money manager where I'm an educator. And so you get some different perspectives, possibly from Chris Schiff than what you may get from me. Another interesting site that is posted periodically with new videos is called the Kindle Report. And that's also, there's so many channels out there, and a lot of them I consider to be pretty much garbage. And if they're not garbage, I probably haven't discovered them yet, but I've been through thousands of different YouTube channels. And now, garbage is a relative term. It may apply more to you. You might be in cryptos. You might do individual stocks, where I take a look at the S&P 500 more in particular. Bob Kindle here, he also looks at the S&P, the NASDAQ, and sometimes Bitcoin. And he'll also go through interest rates, and if things are happening there, he has some unique indicators that you might find helpful. Okay, let's go back and talk about the week's session that just ended. So for the week, we were up 3.93%, almost 4% we gained on the week after we had turned quite decidedly negative. But we were below average with volume, and that is one thing to be aware of. We have price going up and volume going down, and that is a classic negative divergence that we want to keep an eye on. When we were headed lower, when we saw the big decline day, that was on above average volume. So now that we're bouncing back up, we're a little bit concerned about that, but ultimately price is the main indicator that we have to follow. Even if we're going up and volume doesn't seem to be confirming that, we still have to go with price anyway. We are positive, both in the short, intermediate, and long term, as I said on the daily video. We're also looking positive here on the weekly video, and we're looking even more positive. This almost 4% climb really helped the technical picture here on the weekly charts. And this past week, we had a number of economic reports that came out, PPI, which was weaker than expected. That's when everything started to shift back over to this scenario that maybe things aren't so bad after all. And so we think that bad news is now good news and good news is bad news, where a week ago, if the economy was really falling off a cliff and inflation was starting to come back, that was more the negative scenario that the market was adopting. We also had CPI come out, which was pretty much in line with estimates. And then we had a big update on Thursday. And a lot of that had to do with jobless claims being weaker than expected, which shows that the employment situation's hanging in there. And retail sales were up much more than they thought they were going to be. And since that's such a huge part of the US economy, the market really liked that. And we just shot higher after those reports came out. We want to keep an eye on all the different geopolitical concerns. There's wars going on between Russia, Ukraine. There's potential escalation in Israel. Of course, you've got the whole situation in the US going on politically now with the presidential election, and anything else that can come flying in and have an impact. Now, for the most part, the market hasn't been paying attention to what's going on geopolitically, but that can always change. It usually doesn't last very long, but it can have a real impact on what's happening. Now, when we took the dive earlier in August, that was really started in the US, but then it bled over into Japan, and that ended up being kind of a short-term event. It came all the way through Europe and back through the US again, but once that was over, it seemed to be over, and then the market has been bouncing up since then. In the upcoming week, we are going to get the meeting minutes from the last Fed meeting, and they'll be diving through that to see if there's any secret meaning that they can find out. Our trend is actually turning back positive. Where a week ago when I did this video, the red line was below the green line. Now we're seeing the green line going back above the red line. That means our longer term trend is now positive, and I'll show you the chart of this. Some points just to make note of here. We had really solid gains across the whole market, especially if you go from Friday to Friday. And the economic data, it has people feeling good that are participants in the market about the economic environment as well as the labor market. There were some concerns when we had the weaker than expected employment report. And it's like, oh my gosh, we're falling off a cliff here. Well, they seem to be shifting back and seeing things in a more positive light now. The pleasing economic releases were PPI, CPI, and retail sales. And all of these helped the market to go higher this week. Housing starts and building permits, they came out on Friday. Now, this was weaker than expected, and these are considered to be leading indicators, since you have to start a house before it's finished and you have to get a permit before you can start building. And so this is a concern, but the market really didn't pay attention to that. We ended up going up on Friday anyway. And we did have good earnings reports that were well received by companies such as Walmart and Cisco. This helped things go higher as well. And then Starbucks, they apparently are getting rid of or already got rid of their current CEO, Laxman Narasimhan. Okay, I've never heard either of those names before. So if he's the ex-CEO, do they call him X-Lax for short? Okay, I just made that up. That's my attempt at a joke. I don't mean to insult anybody. But that person stepped down, and they're Chipotle. I can't ever say that name either. The CEO from that company is going to be heading over to Starbucks. All right, that's kind of interesting. And then Google is running into a little bit of trouble. Now, if you were around in the late 90s and you were involved in the market, Microsoft went through this. They were just getting too big, and the government felt they needed to step in and do something. And it pretty much all surrounded Internet Explorer, which I don't even know if that software exists anymore. But they ended up breaking the company up into 3 different parts. It really didn't change anything. But during that time, Microsoft really went sideways as they were under all this pressure. Well, now they're looking at Google. It says the Department of Justice may be looking at breaking up the company, which in the long run may not really change anything. It's just one of those feel-good things that the government likes to do, to think they're doing some changes. And they're concerned that Google has they have too much of the market when it comes to search related laws. Okay, well, it's even become a verb. I'll Google it and see what I find out. I mean, That's how big Google has come. But before that, there was Yahoo, there was Alta Vista. Let's see, there were some other search engines out there. But Google has quickly come in over the last couple of decades and become the main search engine that everybody uses. A lot of people actually use Google for their homepage. All right, interest rates declined. We ended up closing down at 3.89% with the 10-year yield where we had been at 3.94%. We're still under that 4% level, and that's helping things. And the dollar fell. That's also giving support to stocks. So looking here, the Dow was up 2.9%, the NASDAQ up 5.3%, the S&P up 3.9%, and small caps were up 2.9%. So we saw across the board gains this past week. This is a chart that I've been showing for over a year now. We're still possibly headed into this, if you look at the light blue line, where we're going down with inflation. I like showing this chart because look at what happened after that. We don't know if things are going to happen this way this time, but we were kind of matching up what was going on from 1966 until about 1976. And then after that, if you grew up during that time like I did, this is when inflation just skyrocketed up and we experienced stagflation during that time. Of course, you've got a lot of economists and doom and gloomers and people they put out videos on YouTube. They want to get views and everything. So they're trying to scare you, giving you a crazy headline just so you'll watch their video. And some of them are using this to justify, we're going to have a 50% crash with stocks and inflation is going to go through the roof. And that may end up happening. But we just take this day by day. That's why I really focus on the daily videos. The problems that we're developing before we saw the big decline, that didn't catch us off guard. And then this bounce back up, we've been following that day by day, and now we're back to looking more positive. And we're using charts. We're using objective information, and lots of it, to reach a consensus. And that's what I do. That's why my videos aren't as popular, because they're longer, and I go into more detail instead of just saying, do this, do that. I'm actually trying to give you tools that you can look at and say, okay, when you take everything together, yeah, there's some concern over here, but there's more positive right now than there is negative. So the chances are that we're going to go up from here. All right. We're also coming down under that 4.02% with the 10-year yield. We're at 3.89%. And that's when we tend to see interest rates more earnings friendly at that point. Okay, then we want to keep an eye on this. Now, this hasn't been updated since August 2nd, but these are folks that are long-term unemployed over 27 weeks. So that's over 6 months. And this is starting to go up, but we're not going to get another update of this until the beginning of September. All right, then looking at earnings going out into the future, whether it's Morgan Stanley or a consensus, they're going up. That's why there's this red arrow that I put on here, and that justifies stock prices going up. And looking at global debt reached a record high, 313 trillion at the end of 2023. Okay, well, that's probably going to be a problem at some point, but nobody seems to care much right now. Thank you, modern monetary theory. Okay. And then looking at the earnings per share, it grew by 11% in the second quarter on a year-over-year basis. The takeaway I would go with is down here near the bottom, 11%. If you take out financials and utilities, still looking really good. Now, they have the Magnificent Six. Which one of the seven don't they include here? And then the rest of the S&P, also, we're seeing pretty much gains across the board here as far as earnings growth. And it's earnings that ultimately drive stock prices. Yeah, there's the day-to-day fluctuations. There's all the market pressures and stresses and things that push stocks up or down. But ultimately, it comes down to earnings. All right, then privately owned housing units authorized in permit issuing places. All right. Well, this is starting to go down, and that's a little bit of a concern to the market right now because this is a leading indicator. And if we see housing going down, usually the economy is not far behind. But this could turn and start to go up. So we'll just watch this. Doesn't mean we're making a prediction. It just means we're a little bit concerned about this right now. Then debt dynamics suggest interest payments to rise. Yeah, I mean, it's getting to the point now where the debt is so high in the US anyway, that so much of the money is going just to pay the interest on the debt. Thank you, modern monetary theory. Okay, FactSet had a number of different posts this week. The market is punishing negative earnings per share surprises more than average. So if you look at all these charts, It just shows that if they come in weaker than expected with their earnings report, they're getting hammered more. And if you want to pause and look at these charts, you're more than welcome to do that. But that's essentially what we're seeing here. Then S&P reporting the largest year-over-year revenue growth since the fourth quarter of 2022. It's going up here now. Now, we're not complete yet, but it is looking better. And so this is also beneficial for stock prices to go higher. And then are more S&P 500 companies discussing recession on their second quarter earnings calls on average? No, not really. It's actually declining. They're still talking about it, but it's not as bad as it had been. If you go from June to August 1st, more people were talking about it than they are currently right now. Because there was a lot of that. If you watch any of the financial media, which I don't, but I saw little videos here and there of people that are supposed to be smart about this stuff saying the Fed needs to come in and do emergency rate cuts and we're going into a recession, everything's falling apart. They're trying to scare you to get you to watch their channel. Okay, it may be factual, it may not be factual. That's why I look at the charts and I just don't. I used to watch CNBC all the time, but I don't anymore. All right, so let's go in. And now this is a little bit longer than usual because I want to go all the way back to August 5th. This was the big down day, and most of the losses were seen in the gap lower. We established a pretty good line of support here. And then we were able to bounce up off of that. Now, we did start coming back down. We were still negative at this point. But since Thursday, August 8th, we have pretty much been able to climb our way back higher. And we ended up closing just off of the high for the week. So we're seeing a really nice bounce continue here on an intraday basis. So just going from Monday through Friday, all of the indexes were positive, with the NASDAQ 100, which had been out of favor there for a while. Now people are starting to fall in love with it again, as well as the NASDAQ and the S&P. They did the best, but all of the other indexes were doing better. Even the small caps were up pretty strong. Now, if you go back to the beginning of the year, we have the NASDAQ in the lead, actually ahead of the NASDAQ 100, and then the S&P in third place, and the small caps continue to show an improvement. They're up on the year as well. Looking at the sectors, we were up across the board with all the sectors, with the tech sector doing the best, up 7.67%. And discretionary, this is an area that we want to see doing better. This is a form of growth versus value. In the financial sector, it's good to see the banks and the whole financial sector doing well. If the financial sector really starts to have problems, that's when the stock market tends to have problems. Now, real estate kind of took it on the chin a little bit. They were still up barely, but they're not really sure about this whole interest rate thing going on right now. Okay, then looking at the scooter score, looking at the sector and rating it on a score of 0 to 100, the utilities are still looking the strongest. They're at 98.7. And then we have financial sector just a little bit above 90. These are the strongest areas. Then we have a couple in the 90s, real estate and staples. These are more, especially staples, are more defensive. Okay, we're keeping an eye on this because staples have been doing well, and this is what folks tend to get into when they're afraid the market's going to decline. Now, on a seasonal basis, historically, September ends up being rather weak, and I'll show you that later on. So maybe folks are worried that after the Democratic National Convention in Chicago that's coming up, and the buzz that's surrounding all of that kind of dies away and reality starts to hit and people get done with their vacations and start school again, maybe we're going to see some selling. Now, we don't know if that's going to happen, but historically, that has been what has happened. And then the weaker areas are materials, energy is seeing some weakness now, and discretionary. This is one of the weaker areas that's been a disappointment. All right, so the sectors, just for the 5 trading days, we had tech, discretionary being up. All of the other sectors ended up being down. Now, I measure this a little bit different. I don't include the S&P gains in this. I'm just looking at raw scores here. And then year to date, we have communication and tech are positive, and the other sectors are now looking a little bit more negative. Okay, here's the relative rotation graph. Up in the right-hand corner, these are the strongest parts of the market. In the lower left-hand corner, these are the weaker parts of the market. And we're seeing things like tech, which had been stronger. Now it's yellow and actually coming down. That means it's showing some weakness. Now, this goes back over a year. It's not talking about the last week or the last 3 months or anything like that. This is going back over the whole year. And then we're seeing utilities, which had been stronger, starting to get weaker. Now they're starting to turn back up. Okay, then we see real estate, which has really been improving. Didn't really have a great week this past week, but over the last year, it's been doing better. And then we have things like discretionary, which is looking a little better, and healthcare. And healthcare is another defensive area that we want to keep an eye on. And then we have staples. We're also watching that, where the other areas like financials, industrials, materials, energy, they're weaker, but they're starting to turn up a little bit, which means they're showing some improvement. All right, so right now we have real estate looking pretty good, discretionary, healthcare. These are the stronger areas and staples. More neutral are utilities and tech. And then when they're red like this, these are the more negative areas. Looking at the market indexes, where we still have utilities showing some improvement overall over the last year. We have the NASDAQ 100. Now it's coming back now, but it's still showing some weakness, although it's still green. We also have the OEX, which is the S&P 100. That's been showing some weakness as large caps were going out of favor there for a while. And the S&P also, they still have some longer term areas of damage to repeat, or to repair, I should say. And we're seeing a little bit of improvement here with the mid caps, and we're seeing some strength a bit anyway with the transports and the small caps and the Dow Jones Composite. All right, and this is looking at utilities and the S&P 100. Even though both of these areas are showing some weakness, they're still the strongest overall. Then we have the transports, composite, and small caps, which are showing an improvement. And then more neutral is the NASDAQ 100 and the S&P, and really showing some improvement, but still quite weak, are the mid caps, which earlier in the year, this was the strongest area of the market. All right, sentiment. And this is one thing that I look at. I don't look at surveys. I don't look at polls. I don't look at all that stuff. I figure folks are really plopping down some money here. So this tends to be, okay, I'm willing to put some money behind it instead of just answering questions. It still has Harris in the lead by 13 cents over Donald Trump. We still have RFK Jr. on the list. Nikki Haley's there for some reason, as is Ron DeSantis, but they're only at 1 cent right now. Okay, then fear and greed index. We had come down and we were in the extreme fear area. And this is when we use this as a contrarian indicator. Well, since then, we've been bouncing back up, and we tend to ride that. When we're down in this extreme area, either to the downside or to the upside, that's when we're looking for things to shift. Well, we had become greatly fearful, and now we're showing some improvement. Now, as we're coming back up, we tend to ride that. And here is a chart where we came down, we were well in the 25 area, and now we're starting to go back up. If this continues to go up, we'll ride that and treat this as positive as well. The active asset managers, okay, they came in, this is a week ago, so there's a little bit of a lag here. They're actually coming down a little bit after being really extreme positive, pretty much at the top that we saw in July. Well, they're paring that back now in our latest reading. And here is another chart of that, where it's coming down more in the neutral area right now. And then looking at the VIX, which was over 60, and everybody was talking about it, even though they had no clue what it even meant, but it was really hitting social media there for a while. Well, it's coming down, and we're under 15 now on a closing basis on Friday, both with the line chart and with the bar chart. And it's not really surprising. When we get into August, a lot of times we see the VIX really going up on a seasonal basis, and that might have been what we saw happening. And this could be the little pullback as we're going back down with the VIX currently. But be aware, on a seasonal basis, doesn't mean that's going to happen this way, but historically it has, where from the latter part of August in through the early part of October, we see a real climb in the VIX, and that means stocks are going down. So we'll have to see if something like that plays out this time as well. Also, with this sentiment indicator, we're not an extreme reading. We're more around the neutral area currently. All right, the Ulcer Index is pretty much going sideways now. We're still getting a pretty high reading on the daily chart. This was designed for mutual funds. It only goes on closing prices. And that's really, it was designed a long time ago when mutual funds were about the only alternative that you had. The Ridex bear bull ratio, these folks keep getting whipped around. We're seeing them a little more bullish. Now, this is as of Thursday. There's 1 day lag on this. But if we go up, they have a tendency to get into the bullish funds, and that means this ratio goes down. When we were really going down, they have a tendency to get into the bearish funds. But we didn't really see much of a spike here. It did go up, but really only lasted for one day, and so they didn't have a chance to really react. And then the latest reading from the American Association of Individual Investors showing some improvement. We're above zero and going back up, not getting an extreme reading currently. This is also turning back positive. This black line is continuing to go down. That means tech is outperforming cash. This is something we want to keep an eye on, but it's showing some improvement. This is the spread between risky and not as risky bonds. And it's a little harder to see here because this is a longer term chart. What I've done here, David Keller from stockcharts.com actually did this, and I just copied what he does. And to match up with the S&P, since this is going up, that means we have higher prices. Well, we inverted this here. This is the spread that we just looked at, and it is starting to go up, which means fear is decreasing. And that's what we want to see if we're going to stay more positive. When we were really going down, this was starting to go up in fear, and that was causing some concerns. Also, you can see all the crazy action here with the VIX as well, and that's also on an inverted scale. The latest reading of Investors Intelligence is probably going to go up now, but it was down around the neutral area of 2.07 in the latest reading. And looking at the economy, we're still coming in about 2% now with GDP now. When we look at the top forecasts, we're anywhere from about 2.5% to the upside and a little bit under 1% to the downside. This also is looking out. The takeaway from this is that both the columns and these black diamonds here are positive. It's when this goes negative for 2 consecutive quarters, that's when we are in a recession. Also, here's another way of showing that. Looking out, we're seeing all these positive columns. We're focusing more on the third quarter now of GDP. And then the Chicago Financial Conditions Index, this continues to be below the black line. That's good. Now, this is a little bit older now. This came out August 2nd. And this is what is causing a lot of the perma bears to just salivate because we actually went above this red line. This red line is set at 0.5. The latest reading that we had here is 0.53. And they're like, oh, this indicator's never been wrong. It has a perfect track record going back to 1999. Well, I actually follow Som. It's a lady, very smart economist, who developed this. And on her own Twitter X feed, she's saying, I don't know if it's going to be right this time or not. Well, about a year ago, probably a little bit longer, the gentleman who won, I think, a Nobel Prize for discovering the inverted yield curve, and then we go into a recession after that, he came out with a series of statements saying, it might not be right this time. Remember, we're coming out of unprecedented times with the COVID lockdowns, with the stimulus, with the Fed throwing rates down to zero, and we're still dealing with coming out of that whole mess. Plus, we have all this geopolitical stuff coming on. So to try to compare everything to right now to exactly the way it was in the past, it's a good guide and it can be helpful. And sometimes things play out similar, but to dogmatically just state, well, yeah, it happened before, so it's going to happen again. History doesn't always repeat itself. I'm a history teacher, okay? And things don't always repeat, but they do rhyme quite often. So that's why we want to watch these things. Okay, then another one that's giving us a little bit of a concern here is the smooth U.S. recession probabilities. This is still below the black line, though, so we're not really freaked out. We get freaked out if we go above the red line. And then the Brave Butters, this is a quarterly index that we look at. It's actually been coming down in the latest reading, but this hasn't been updated since the first part of July. All right, then we did see a tick down in inflation as PPI, CPI, we're still waiting a week or two off yet for the PCE report to come out, but we are seeing inflation starting to come down in the inflation now casting. And this is where we saw a bit of a change. And I'll show you this on the next slide. There's now a 75% chance that the Fed is going to lower rates 0.25% at their meeting on September 18th. Now, if you look at this, if you go back a week ago, where it was almost 50-50, here's a week ago here where I have my cursor, and then over here, here's a week ago, there was a 50-50 chance between a 25 basis point cut and a 50 basis point cut. Well, since CPI, PPI, retail sales, employment, jobless claims, all that came out, we're seeing it get firmed up again with just a 25 basis point cut. That's what the market is. Now, there's a 100% chance that they're going to cut rates. It's just now it had been 50-50 between the two. Now it's leaning heavily towards a 25 or 0.25% cut in September. Then looking out at the next meeting, that'll be on November 7th, where they think that after that meeting, we'll be at 4.75 to 5. That would be 0.5% lower than we're at now. And there's even a third of the people that think we'll be even more than that, and 4.1% that think we'll be even down more than that. But this changes all the time, and it's going to fluctuate quite a bit. This just shows how we're getting locked in. The market is anticipating this rate cut in September. They're also anticipating another 25 basis point cut in September, or I'm sorry, in November. So we'll just have to see. All right. And then looking at the balance sheet for the Fed, it shows it going down over here, but we're seeing a real increase up here in the latest reading. And then we look at a year over year basis where it seems to be going up. And we're also seeing a decline here. Isn't that interesting? Only government charts can do this. They can go up visually, go down numerically. All right, then we keep an eye on this. We're just looking for some kind of a spike in a general trend of going up. This is the overnight reverse repurchase agreements. When this goes up, something's usually going on at that point that may do damage to the financial sector. But right now, things seem to be calm. All right, looking at our breadth here, based on price and volume, we're showing some improvement, but we're seeing a little bit of a negative divergence here. We're breaking out based on price, and we're seeing that on the daily chart. We're also improving based on volume, but we have not broke out above this previous high. So there's a little bit of a negative divergence here, and we're also seeing that on the weekly chart here as well. Okay, we're still hanging in there pretty good internally when we look at new highs versus new lows. And we're still seeing way more new highs than new lows, but it's not really breaking out at this point. In fact, our 4-week moving average continues to decline, and our 10-week average is still declining as well. But you can tell just by looking at the green versus red here, just like the Canadian TV show, red, green, where we're seeing many more new highs than new lows right now, and that's overall positive. All right, we're still above zero and going up with our advanced decline ratio. That's positive. And this is still positive. Now, we went negative with the accumulation distribution on the daily chart. We never dropped below the moving average here on the weekly chart. So longer term, we were holding up better. And we're starting to go back up, and the boom indicator is above the midpoint and advancing. So this is now positive, a smart money indicator. It not only takes price into account, but also volume. Then looking at our trend, this is where we're kind of jockeying around. A week ago, I told you that the red line was above the green line, and it was. Well, we had the up week, and now the green line's back above the red line, so now we default to positive. But while this is gyrating around, the ADX is getting weaker, and it's below its moving average. But we're still above 20. That's a static number that we use here. This suggests a positive weakening trend, but we're still trending anyway because we're still above 20. All right, then the Erin indicator, after being extreme positive, is starting to come down a bit. The mass index, we have 2 of the 3 parts of this signal that have been triggered. We're waiting for part number 3 on the daily chart, where we don't have any of the signals triggered here. When this does trigger with all 3 parts of the signal, it's suggesting a reversal in whatever trend is happening at the time the 3rd signal is generated. Okay, here's the daily chart. We really helped a lot this week. We were able to get back above the 50-day moving average, and we were able to get above this pivot point here on the daily chart. So this is quite constructive right now, because when we were going down, we had gaps on the way down. Well, we've been able to fill those, and instead of filling them and then turning and going down, we've been able to keep going up. Now, are we going to go back and set a new all-time high? We don't know. Things are looking positive now, but they can change quickly. The one thing that I have been talking about, though, is this is a daily chart. And as we've been going up, you see how volume has been dropping below the moving average. That's a concern. But when you look at the Keller market model across all time frames, across all the indexes that we follow, we are positive. When we look at different markets, we're positive with stocks and bonds across all time frames. We're negative across all time frames with commodities and the dollar. And we're positive across the board here with the decision point scorecard. That has switched back now. Okay, we're still well above the trend line here, the midpoint of the trend channel. And I haven't extended this yet because we haven't come back up to this level. If we keep going up, I'll probably draw this out a little bit. This is also positive. When we really declined, we came all the way down to this R1 level at 5110, 5111. If you've been watching my videos for the last year or so, you've got sick of seeing this chart because we were battling around this level for a long time, and then we finally broke above it. Well, when we declined, and I was watching this was part of August 5th right here when we hit a low. And so we saw this happening on different time frames all at the same time. We saw it intraday with a pivot point. We were hitting support there. We were hitting support here on this chart. We were hitting it on other indexes. And I was watching all of that. That's why I really stress watching the daily videos, because we were seeing all of this unfold. And then we started to come back up and we were able to get back above R2 and close above it. So this is quite positive. Then when we look at the longer term trend with a 50 period moving average here, that's 50 weeks. We're going back up now and the red line's going up and we're above the red line. That's positive. When we use a crossover type of a structure here, we're back above the 13-week moving average and both lines are going up and price is above both. That's positive. We're looking better here with the bullish percent index. We had dropped down below 50. That's negative. We're able to get back above it and we're showing some good strength. These are point and figure buy signals or sell signals inside the S&P. And with this going up, that means it's not just the Magnificent Seven, because those are included in the S&P 500. We're seeing more broad buy signals being generated right now. So this is showing more strength throughout the S&P 500. We're also looking pretty good. We're above zero and advancing with the McClellan oscillator. That's positive. And we are going up with the Swenlin trading oscillator based on price and volume. That is positive too. And we look at the summation index. We're going up based on price and above zero. We're crossing back above zero here based on volume. That had been a concern. When we were going down and looking more negative, it seemed like volume was leading price. Well, ever since we had that big down day, volume hasn't quite repaired itself yet, but it is showing an improvement. All right, then we look at momentum. We're still rolling over here with the PMO. So that needs to show some improvement additionally, but we're still above zero based on price, and we're just crossing back above zero here based on volume. And we're seeing an improvement internally. These are all the stocks on a weekly basis with the PMOs that are rising. That's going up. With the PMOs that are generating buy signals, that's going up, and the PMOs that are above zero are also back to going up after we had been seeing all of these declining. Okay, the Bollinger Bands were not above or below the upper or lower band right now. The positive takeaway from this is that we came down almost to the midpoint and we're above the midpoint. That means we lean more positive. Here is our momentum. We're rolling over a bit with the slope and TSI. Now, if you look at the daily chart, we're turning positive in the short and intermediate term. We're showing an improvement, but we haven't turned positive in the long term. We're here with the short and intermediate term weekly charts. We're still negative. Intermediate term, we're also still negative, and we're still rolling over here in the long term. So on a momentum basis, the charts need to catch up with what's happening with price. All right, the chicken money flow, another one of our smart money indicators where it's actually looking more positive. We had become really extreme negative on the daily chart, and we're starting to turn up, and the red line's going up. Well, we saw a bit of a bounce here. It's not quite back to looking positive yet, but it is improving. Chicken oscillator, this is positive because we're above zero and going up. And we're actually going up on the daily chart as well. So we're seeing confirmation with the daily and weekly chart here. The force index, also above zero, and it's green, that's positive. And we're still above 50, even though we were flat with the money flow. And this is the rate of change from one week to another. Just we don't see 4% gains week over week all that often. So that's why we're above the red line. And then the 50-week rate of change, we're just kind of dancing along above this red line. This could suggest good longer-term momentum. We're still negative with the special K. We're still positive on the daily chart. Well, we're still below the red line here on this one. And we're showing an improvement after being extreme negative with the Stochk RSI. We haven't crossed above the midpoint yet, but this is starting to bounce back up. We are looking more positive and not necessarily extreme with the Williams percent R. We dropped a little bit below the midpoint. Now we're bouncing up here as well. And the ultimate oscillator crossed back above 50, and that's turning positive again. The vortex still has the green line on top. It had been coming down as the red line was coming up. Well, we're ticking back up with the green line and going down with the red line. So this is looking more positive now too. And we're still negative here with the Copic curve, but we're trying to turn back up, but we haven't crossed the moving average yet. We're looking better here. We never came down to 50 with the long-term 14-week RSI before we started to go back up. And when we have most of the price above 50, which is what we've had for most of 2023 and now into 2024. That means good, solid, longer term momentum. All right, and then we almost came down here to the 40-week moving average. Didn't quite hit that, and then we bounced up off of that. And now we're back above the 10-week moving average again. So we're reclaiming territory that was lost. All right, we're starting to go back down here with the 253 period equity put call ratio. When this is going up, that's negative. It's now starting to turn back down, which is more positive. Also, starting to come back down when we look at a ratio between the VIX and the 3-month average of the VIX. It had been going up. That tends to be more negative. When this is going down, that tends to be more positive. Then our different charts looking better here with the Heiken Ashi, where we were seeing black candles here, that's negative. Now we're seeing open candles, which are positive. We're still negative here with the Kegi since it's red, but now it's pointing up instead of pointing down. And we're positive here with the Renko chart with open blocks. And we're still negative here with the 3-line break. It still wants to see more than what's already happened. And now the reason this is in the chart section is mainly because of the equi volume. This tries to take price and volume. The thicker the bar here, the more volume went into a particular move. So it's trying to combine them. And that's why I put this chart here. But the indicator that I usually follow is down below. It's the ease of movement, the path of least resistance. And we dropped a little bit below zero. Well, we were able to come back above that. And this is based on 14 weeks. Okay, we also saw lots of nice little green X's coming in here over the past week with the point and figure chart. Not enough to generate a signal, but we are working off of a low pole reversal signal on the daily chart. But this is showing an improvement too. We're still flattening out a little bit here with our long-term trend. When we look at the PPO, we're going back up in the intermediate term, and we've turned back from being negative to positive in the short term. And then we're coming up at some point here. And the reason I say some point, I put my mouse over here and it tells me the date. Well, if I just move it like a nano millimeter, it changes the date. And so I'm never quite sure. It looks like it could be August 19th, which is coming up now, which again, I don't put a lot of faith in this 50-day cycle. Sometimes it marked the top, sometimes the bottom, sometimes it was completely irrelevant. So there are people that use a lot of cycles, and I've just been using this for the last couple of years to see if there's anything really to it. All right, we are turning back from negative to positive here with the Elder's Impulse System for the S&P. We're still negative, though, with the parabolic SCR. Now, we did turn over positive on the daily chart, but we're not seeing a confirmation here. We still need to see more upthrust here for a dot to come underneath, which would turn this chart positive. Looking at the S&P, we did see a nice little bounce, especially after that decline. The mid caps are showing some improvement here, but not really breaking out yet. And the small caps are bouncing up after seeing some weakness as well. And we're in the month of August now, where we're up over from 2020 to 2024. We're up 60% of the time with a return of 0.9%. It's September that is causing a concern. We've been down every year over the last, well, since 2020 during the month of September. Now, we don't know. This year could be different, but it could also be the same. All right, looking at the Dow, we're back above the 13-week moving average and in an established uptrend. We're in an uptrend. We were able to get back above the 13-week moving average with the NASDAQ. We're also showing a lot of improvement here with the NASDAQ 100. We're back above the 13-week moving average, and we're seeing two really solid candles here. After we had been looking rather ugly, now it's looking a little prettier if you're positive on the market. We're looking at the mid caps, also showing an improvement above their 13-week moving average. Small caps as well, or excuse me, the NYSE is showing an improvement as well. And the Wilshire was able to get back above. Now, this is a daily chart here. We were able to get back above the 50-day moving average, and this is another broad market measure. All stocks coming back above their moving average as well, showing some improvement here. The 30 biggest software companies, not really doing all that much, but looking more positive as of late. The FANG index was able to get above its 13-week moving average. This is tech. This is Facebook, Apple, Amazon, Netflix, Google, and NVIDIA's in there somewhere too. ARK actually bounced up a little bit, up 6.33%, but still coming up to its moving average and still in a longer-term downtrend. Small caps bouncing above their 13-week moving average, but still have a ways to go to break out. And the banks looking good. We're above 50 with the RSI. The chart is looking a lot healthier. And we're kind of right on top of each other as far as momentum as measured by the MACD. Looking at Dow theory on a weekly basis here, we have not set a new all-time high with the Dow. We're still lagging behind with the transports. The utilities were really breaking to the upside. Well, they've been under a bit of weakness as of late. And then deposits. This just shows that, and again, look at this government chart here. Shows that it's going down with deposits, but look at the number. It's positive. Woohoo. All right, and this is another chart of Dow theory. So in case you missed it the first time, you can see it again here. Then looking at the CRB index, we are seeing a bit of a bounce after commodities had been quite weak here. Oil is actually coming down. We're in the mid 70s now. This is what we want to watch if things really escalate in the Middle East. If this really spikes up because things are blowing up in the Middle East between Iran and Israel, that's going to be negative for stocks. Copper still not really looking all that strong, even though it was up 3.25%, 3.75%. It's showing some improvement, but still has been under a lot of weakness lately. The dollar, we're starting to cross over and seeing a weekly death cross here. We're still looking at a positive trend on the daily chart, even though their weakness is showing up there also. But these are crossing a little bit quicker, and that tends to support stocks. The stock market likes a weaker dollar. Gold, well, just breaking out here, and all the gold bugs are patting themselves on the back, even though they've been talking about how it's going to break out for 20 years. Finally, it's doing it. If you say the same thing long enough, sometimes you end up being right. Silver is not breaking out yet, but also in an uptrend, but it's below its 13-week moving average. Looking at the price of bonds, really showing some improvement here with the total bond weekly ETF. The monthly chart, where we had come all the way down to the moving average before, well, we're showing a little bit of improvement. This is a monthly chart, so it's not going to be completed until August is over. All right, then here's a daily chart showing how interest rates have been coming down, and then we started to spike up as the world was freaking out. Now we're starting to come back down again. Then this is a weekly chart looking internationally with US and UK rates the highest. Germany was up a little bit, and Japanese rates are now falling a little bit more. All right, then here's the intermarket analysis. We have gold year to date doing the best, followed by stocks and then oil. We have the dollar, and then back being positive again is our bonds based on price. And then we look at some ratios. The NASDAQ 100 to the S&P showing some improvement, still in a longer term uptrend. In a really solid environment, we want both to do well. But usually the NASDAQ 100 outperforms the S&P to the upside, even though the Magnificent Seven are in both indexes. Then the S&P 100, the biggest stocks that make up the S&P, showing some improvement after really falling back. Growth to value, seeing some improvement here as well. We want this to go up if we're more positive. Gold to the S&P, not really breaking out all that much, even though gold has been doing well lately. But with the S&P bouncing on a ratio basis, it's not necessarily outperforming. Gold, I mean. Gold is outperforming the dollar. Gold's been going up as the dollar's been going down. So that's why we're seeing this chart going up. And we're seeing this turn and come back down now when we compare bonds with stocks on a longer term basis. Low volatility to the S&P. When this is going down, that means the low volatility or more defensive stocks are underperforming. Well, when we were starting to freak out, they were finding some favor. Now this is starting to come back down. Energy to tech still shows tech underperforming. Energy underperforming when we're going down here. Discretionary to staples. This is a little bit of a concern here. We want discretionary to do better. Staples is actually doing better right now, and that's more defensive. We're concerned about that. And we look at a ratio between small caps and the tech sector. When this is going down, that means the tech sector is outperforming. We were starting to go up as small caps were seeing some love. Now it's starting to fall back down. And longer term, this is the NYSE breadth thrust. We've been working off of that signal since October 2022. And we don't have any new swag NYSE breadth thrust yet. We're still working off of the one that was generated last October. And these typically are good for a year. And these are the historical results when we do get a swag NYSE breadth thrust. Here's a long-term weekly chart going back to 1987. Even after our decline, we're still well above this trend line. Here's a further blow up of that, showing how the S&P is improving. And we're still on a full-on Zohorchak buy. That didn't change. And when we look at the new highs, new lows, and take a 50-period moving average on the NYSE, this is still going down, although it might be starting to tick back up. This is going to take longer to show some improvement. We dropped below this weekly chart of this trend line with the NASDAQ 100. Now we've been able to get back above it. Here's the S&P, new highs, new lows, and a 50-period moving average coming down, but starting ever so slightly to turn back up. Here's a NASDAQ 100 to Dow ratio coming down to this previous high level and starting to go back up. That's more positive for the market. The Qs to small caps, also the Qs are starting to outperform. We're going back above this blue line. And we're going back up a little bit here with our cumulative new highs, new lows for the NASDAQ. Down here, this is just a daily score that I keep track of. This is longer term, where we have been declining for years. We were flattening out. If we could turn and go back up, that would be much more positive for the NASDAQ. Looking at semiconductors to the Dow, coming down, drop below the blue line. Now it's starting to come back up. And then here's that same chart again, just in case you missed it before. All right, we do want to keep an eye on the 3-month yield. It was coming down. That was causing a little bit of concern as folks were worried about the economy falling apart. Now we're starting to go back up a little bit here, even though we were down on the week, or at least on Friday. We want to keep an eye on this because this is how we got led into the great financial crisis. First, we saw the 3-month just going down, down, down. Well, we were getting a little bit concerned, but right now it seems to be holding up. Seasonality, our August. Can't you just feel the positive seasonality that we saw? Yeah, right at the beginning here was the big down decline, but now we seem to be looking a little bit better. It's September that ends up really being rather painful for the stock market during an election year. August tends to look good, going back to 1950, but September does not. August looks good on a world basis here, but I'm sorry, it doesn't look good on a world basis. It's good on a U.S. basis, but September is also negative as well. We just want to keep this in the back of our mind. When we take June, July, and August during an election year, they tend to all do quite well. All right, but we look at June, July, and August here, they look good, but September and October quite often are negative. And then we're done with the first half of August, and that tends to not do great. It's the second half of August that historically tends to do better. And then going back to 1950 during an election year, the S&P is up 11 out of 18 times, down 7 out of 18 times. So it has a pretty good track record that way. And the average return is 1.3%. So thank you. I really hope you found this helpful. I hope you have a great weekend, and I will talk to you in the next video.